Jake buys Bitcoin at 42,000. Within an hour, it's down 3%. He doesn't sell, not because he has a plan, but because selling would make the loss real. 3 days later, that 3% loss is 9%. He still hasn't sold. This is not bad luck. This is a wiring problem in his brain called loss aversion. And by the end of this, you will know exactly how it drained his account and how to stop it draining yours. Rewind to the entry. Jake spotted a bull flag on Bitcoin, a simple pattern bullish, and it's a continuation setup, meaning the trend already going up was expected to keep going after a short pause. His trigger was a candle closing back above the flag's upper line. His stop went below the flag's low with a little wiggle room so a random wick doesn't shake him out early. His target was set at 2 times his risk, using a clean risk to reward frame. Textbook entry, but here's what textbook entries never tell you. Patterns fail. The pattern isn't what protects you. The stop is. Jake had all of this right. What he didn't have was the discipline to honor his own stop once price actually got there. That part is coming up. So what actually happened in Jake's head? There's a concept called loss aversion. You feel the pain of losing money roughly twice as strongly as you feel the pleasure of gaining the same amount. Picture 2 bars. One bar is the joy of winning $1,000. The other bar for a $1,000 loss is roughly double the height, same dollar amount, double the emotional weight. That asymmetry isn't a character flaw. It's measured, repeatable human wiring. And it explains something that sounds backwards until you sit with it. People will turn down bets that are mathematically in their favor purely because the word loss is attached to the downside. Let's test that on you directly. Here's the bet. I flip a coin. Heads, you win $150. Tails, you lose $100. Would you take that bet, pause the video, and actually decide before I show you the math? Ready? The expected value here is positive. On average, this bet pays you $25 every time you take it. Mathematically, you should take it every single time it's offered. Yet study after study shows most people say no. Why? Because loss aversion makes the $100 loss feel bigger than the $150 win, even though the math says otherwise. This is the exact same wiring that kept Jake in his losing Bitcoin trade. Rejecting a good bet and refusing to exit a bad one are 2 sides of the same coin. Back to Jake. Price hits his stop. Alarm goes off. He doesn't take it. His new plan, and I use that word loosely, is just get me back to break even. That's the break even mentality. Refusing to exit until price crawls back to your entry as if the market owes you a return trip. Bitcoin doesn't crawl back. It keeps falling. Jake is now down 15% on a trade that was supposed to risk 2%. This is holding losers too long, and it is loss aversion doing exactly what it's designed to do, making the guaranteed small loss feel worse than the possible bigger one, even though the math says the opposite. Here's the part that actually saves your account, so stay with me. While Jake's capital is frozen in a trade he refuses to close, it isn't just losing value, it's absent from every other trade he could be taking. That's opportunity cost. Picture 2 bars again. Bar 1, the capital stuck in Jake's losing Bitcoin position, going nowhere for 2 weeks. Bar 2, the same capital, if it had been cut at the stop and redeployed into the next clean setup, compounding instead. The gap between those 2 bars is money loss aversion cost him that never even shows up on the losing trade's own statement. That hidden bar is often bigger than the loss itself. Now go find this on your own chart live. Pull up Bitcoin right now. Scroll back to any red candle that ran further than it should have and ask yourself the honest question, is this a setup I'd take fresh today at this exact spot, or am I only still in it because I don't want to admit the loss? Here's the part experienced traders will tell you matters more than any pattern: context. The exact same red candle means something completely different sitting on top of a major level than it does in the middle of open air. The shape of the candle is not what should decide your exit. Where it's sitting is pause here and actually scan for it before moving on. This is the payoff of everything we just walked through. Loss aversion isn't one isolated mistake sitting off to the side. It's the root a lot of other trading errors grow out of. Revenge trading, trying to win back a loss immediately, grows out of it. Over trading to chase away the discomfort of an open loss grows out of it. Even ignoring your own stop loss order like Jake did grows out of it. Draw it as a trunk with branches, loss aversion at the base, and every one of those other biases forking off it fix the root, and a lot of these other habits get noticeably easier to fix too. That's exactly why this sits so early in how we teach trading psychology. Let's close the loop on Jake. He didn't lose because his bull flag was a bad pattern. It wasn't. He lost because loss aversion made him blind to his own stop, then trapped him in a break-even fantasy while his capital sat frozen doing nothing. Same wiring, every trader, every market. Quick recap, losses hurt roughly twice as much as equivalent gains feel good. That asymmetry makes people reject bets that are mathematically in their favor. It makes traders hold losers, hoping for break-even instead of cutting clean. Frozen capital carries a hidden opportunity cost, and loss aversion is the root a lot of other bad habits grow from. Here's the rule to write down. Amateurs protect their ego. Professionals protect their capital. Tell me in the comments what's the losing trade you're still holding right now, hoping it comes back. Name the pair. Next time, we're taking the bias that shows up right after this one. The moment a small win convinces you to take on way more risk than you should.